get so confused with economics, because you'll see a headline like, you know, retail investors are crushing a hedge fund through a short squeeze. Okay, great. I don't know what any of those words mean. And then you'll say I have an whole article. So we're going to cover a couple terms that you may or may not have heard, or may or may not have understand what they are, and basically simplify this. I'm going to simplify a lot of this to understand what's going on. Even though it's simplified, you'll still understand 90%, 95% of what's happening. And you'll probably understand way more than most people. So here's our first term we're going to go over, hedge fund. And this is, man, this is one of those terms that I don't know if I've really ever met anybody that truly understands what's meant by a hedge fund. So quick show of hands, how many of you have heard the term hedge fund before? Okay, so a few of you heard the term. This is one of those terms that for some reason has gotten this really bad rap. When in fact, people don't really know what hedge funds are. So before I give you the definition, here's a good basic question. Where have you heard that term before? Hedge. Not in finance. Has anybody heard the term hedge before?
Like in landscaping, I guess.
Exactly, like in landscaping.
Or
so if you have a hedge, yeah, if you have a hedge around your house, it's usually, you know, somewhere between 3 feet and 6 feet of really solid shrubbery. And the whole purpose of the original purpose of a hedge, now it's more kind of decorative, but the original purpose of a hedge was to, one, for privacy, but the other one was to keep animals out. So you have this really, really thick pile of bushes. Now deer aren't going to come in and they're going to eat your prized petunias. And coyotes might not be able to make it in. So now your farm animals, you have your cats and dogs outside, they're protected. So the original idea of a hedge, and this goes back to the 1400s, a hedge was actually designed for protection. So you would use it, put it around your property to protect your property. Well, same definition is applied to a hedge fund. A hedge fund is simply a fund that is designed to protect you from risk. Now, that's not a really good definition. It's because it doesn't really protect you from risk. There's always risk in investing. You can always invest in something and lose money. But what a hedge fund does, this allows people to invest in what we're going to call alternative investments. So this is alternative. Alternative investments. Now, great. Alternative to what? Well, in our case, alternative to the standard stocks and bonds and things that we looked at in this class. So most people, when they're investing, they're buying stocks. They're buying ownership of a corporation. And they're hoping that they're going to hold those stocks, and at some point the value is going to go up, and they'll sell. And maybe they'll sell in a month, maybe they'll sell in a year, maybe they'll sell in 30 years when they retire. But that's your basic investing, and that's what most people do. Now, the challenge is, well, what happens like in March and April, May of this year, or in January, February, March of 2009, when all those investments plummet in value and just kind of go down? Well, there's other things you can invest in. You can invest in things that aren't just stocks. Individuals do this all the time. People invest in real estate. Maybe you've got maybe real estate that you own that you live in, and that's going to increase in value. Maybe you sell that when you retire. Maybe you own a second house that you're going to rent out to students or rent out to people doing short term like Airbnb. That's a different type of investment. That's not a stock investment. That's a different type of investment. Some people will buy wine and hold on to it and sell it later at a higher price. You can invest in racehorses. You can invest in all kinds of different things. Most people invest in stocks because they're easy. We know the value, they're liquid, so we can always exchange them for cash, things like that. But there's all these different other types of investments out there. And this is where hedge funds come in. Hedge funds allow people to invest in things other than just basic stocks. And where that term hedge, that protection is you can take some or all of your money and not have it be dependent on how the stock market's doing. So hedge funds range all kinds of different things. They can do things like we're going to talk about, bet against the market, where the value grows when the market goes down rather than going up. We'll show how that works. You can have hedge funds that invest in only commercial real estate, where they're going to buy up ownership in commercial real estate, and they're going to take your money and use it to invest in commercial real estate, and then maybe sell that later for a gain. And that's how you get your money. So it allows people to do different types of investing. Now, the problem, and maybe now problem's not the right word, the challenge, how's that for good terminology? The challenge with hedge funds is they're not always easy to understand what they're investing in, because sometimes these alternative investments can be kind of complicated. And, there's one thing, and this is what I always tell people with investing: don't invest in something unless you know how it makes money. What's going to make it earn money, what's going to make it lose money. If you don't understand the stuff, you shouldn't be investing your money in there. And this is when and I always get, everybody, like 90% of the people come to me, the only questions I get are, tell me about Bitcoin. And that's always my first question. What drives the price up? What drives the price down? If you know the answers, then by all means, go invest in that. If you don't know the answers, that's probably not something you should invest in. So with hedge funds, people don't always understand what makes the price go up and go down. These can be very complicated investments. So because of that, there's heavy regulations around hedge funds. People like you and I cannot invest in hedge funds. Hedge funds are only permitted to take money from people who are known as accredited investors. And an accredited investor, this is something that's defined by the Securities and Exchange Commission, which manages or regulates the entire stock market. This is basically someone that has at least $1 million in cash to invest. So again, this is not me. It may be you. I'm not quite sure of your financial backing, but I'm going to guess that most of you are not accredited investors. I'm not an accredited investor. I don't have $1 million to invest. So hedge funds can only do that. And the thought behind that is, these are complicated investments that these hedge funds are doing. Not that you're super brilliant if you have $1 million to invest. You could be really dumb and lucky. But the idea is, generally, if you have that amount of money, you're probably a little bit more financially literate in general than most people. So hedge funds can only take money from basically wealthy individuals. So that's a hedge fund. Any questions on that before we get into our next term? Or does that make sense?
So is the hedge to keep poor people out of investing in it? Is that what that is, or?
Not necessarily.
Isn't it like a team risk thing? Like if you already have money, you only want other people with money to help?
No, it's really, like I say, this is, and I'm not saying it's right or wrong to have that, but that's a regulation that was put in place by the government that says you can't invest in hedge fund unless you are an accredited investor. And again, the idea is not so much, we want to keep poor people out, because let's face it, if you have $900,000 to invest, you're probably not poor, but you still can't invest in a hedge fund. So the idea is we don't want people just throwing money into these alternative investments, because there's a good chance they don't understand what they're getting into. I don't necessarily agree with that. And there are some people that don't necessarily agree with that. But that's also my view on regulation in general. I don't usually agree with. But it's, basically what your hedge is, or what your protection is it allows you to protect some of your money from possible market failures, like the stock market. And there's some crazy hedge funds out there. You've got hedge funds that invest in completely non-market things like weather. There's a whole market for what's called weather derivatives, where you make money if the weather is a certain temperature for a certain number of days or not. Catastrophe bonds, where they pay out if there's not a certain number of hurricanes in Florida over the course of a year. So you've got all these things that have nothing to do with financial markets they can invest in. They can also invest in things like oil futures and all kinds of really crazy. Yeah, go ahead.
I forgot what I was going to say. Sorry. I had it all lined up.
If you remember, just holler. So that's a hedge fund. They had this painting, it's weird. They had, I think part of that whole, like, hey, these things are evil, is because they only let accredited investors invest. But like I said, that's a government regulation. That's not hedge funds saying we don't want your money, poor people.
So if hedge funds are essentially protection for large investments or protection for large amounts of money, then why can't, or what would the reasoning be for why smaller investors or amateur investors can't use these alternative methods?
Because it's not a guaranteed protection, and as we're going to see, you can lose a lot of money, and you can lose a lot of money in the stock market. But it's again, if you don't understand how the investment works, that's not something you should be investing in. And again, just because you have $1 million doesn't mean you automatically understand how cattle futures work. But you've got hedge funds that invest in nothing but cattle futures. The idea behind that is just, if you have less than $1 million to invest, which is most people, stick with the stuff that is less risky and easier, like the stock market. You can lose a ton of money in hedge funds, which is, again, what we're going to find out. So what they do is they take bigger risks, but it tends to be bigger risks that are different than the stock market. So they can do really, really well and make a ton of money, or they can do really, really and lose all their money. Chances are you're not going to lose all your money if you invest in the stock market, but you could possibly lose all of your money. Or what happened this past week, you can lose half of your entire investment if you put it into a hedge fund. So think of it as higher risk, higher reward, and that's why it's alternative. It's not so much a protective investment, it's an alternative investment. All right, so any other questions? Good questions, Sue. So the next term we're going to get to is a short sale. So short sale is kind of how hedge funds were invented back in the 1920s. A short sale pays out or increases in value, we're going to say, when a stock that you have the short sale on decreases in value. So this pays out or it increases in value when the stock decreases in value. When we talk about this term short, the opposite of short is, in the stock market at least, long. Most people are long in the stock market. When you're long, that means that you gain money when the value of the stock increases. So you're long if you own stock. So let's say you own 10 shares of Zoom. Well, you're long on Zoom. That means that your investment increases when the value of Zoom increases. The opposite of being long is being short. Short is when your investment increases in value, when the stock decreases in value. I'm going to show how this happens. So let's move these guys over here. These pictures are here for a reason. I didn't just try to make this fun. I mean, I tried to make it fun, but. So the way a short sale works is you'll have a hedge fund, and what they'll do is the hedge fund will, let's move this down. So the hedge fund will borrow stock, borrow shares of stock, and immediately sell those shares of stock. So we're going to give an example here. Let's just say it's $10 a share. Keep the numbers easy. So if you want to engage in a short sale, and a short sale is something that you can do. It's risky, and you tend to need, you can do it with smaller accounts. I don't mess with short sales. There's a different way to get into short sales that you can do that's a lot less money intensive. So you immediately borrow from somebody else shares of stock and you sell them right away. So we're going to say that we borrow and sell at $10 a share. And we're going to keep this easy, right? We're just going to say one share. So we're going to keep this math. So that means, boom, right now you have $10. Now, part of this agreement is you're borrowing shares from somebody. And think about what happens when you borrow something. I think we learned this like way back in first or second grade. Like, just so you know, when you borrow somebody's toy, you have to give it back when you're done. And then you get older and you're like, hey, when you borrow money for school or for a car, you got to pay that money back. Well, it's no different here with a short sale. If you're borrowing shares of stock, you have to return those shares when you're done with them. So at some point in the future, and when you engage in a short sale, there's a very specific date that this occurs. And that date is however long you want it to be, however long the person lending to you will allow to use it. But there's a very, very set date. After you borrow and sell, you have to buy and return. So first you borrow and sell the shares at $10. And later you have to buy those shares back and return them to the person that you borrowed them from. Now here's what happens when a short sale goes really, really well. So let's say you borrow and sell at $10 a share, and boom, that stock price plummets. So now, say it's only $3 a share. Well, guess what? You are buying that stock back right now at $3 a share, which means you sold it for 10, bought it for 3, which means you've now earned $7. So usually we buy something and then we sell it. This is just taking that and doing it in reverse. First we're selling it, then we're buying. Yep.
Who and why, mainly who are these people that have all these shares and are deciding to let someone borrow it instead of just selling it themselves?
Because there's a couple reasons why you wouldn't necessarily want to do it yourself. One is if they're borrowing your shares, they're going to pay you interest. So that's a pretty good way for you to earn interest on this investment. The other thing is if you're engaging in a short sale, you have to have what's called a large margin account. Because and what we're going to see what happens, if that price goes up, you've got to have enough cash to buy those shares back because you are contractually obligated to do that. So if these shares go to $50, well, you better make sure you've got $50 in that account because that's what's going to cost you to buy them back. Is that what you were asking?
So,
both parties benefit from this.
What kind of a profit margin would the original owners of the stock have if everything went well with the short sale?
So you mean the ones that are lending the stocks out?
Mm-hmm.
They'll generally get, so the interest on margin is about 10%. So they should get a 10% on however long this is. This could be a month, this could be 3 months, this could be 6 months, it could be a year. Generally, it's 10%. So basically, in this case, let's say this happened over a year, the person lending this out would earn $1 on this. But if you think about it, they're earning this $1 pretty much risk-free because they don't have to do anything. So there's always two sides to this. So does everybody see how our stock price decreased here? Went from 10 to 3. And that's how the short seller earned $7.
So that makes it their goal to bring down the price of that stock so that they make money on it?
It's not their goal to bring it down. For them to bring it down, that's illegal. That's called that's market manipulation. But they are engaging in a short sale because they think the stock price is going to go down.
So you go first.
Isn't it not unheard of, though, some of these firms that like to call shorts to also try and coincide it with releasing a report on why they think a company is going to fail or is overvalued?
Yeah, so you're always allowed to talk about why you think the company's going to fail. What you can't do and what market manipulation is. What you can't do is say, you know, hey, I think this company's getting investigated for fraud, if that's a lie. Because now you've just done a lie, and everyone's like, oh, they're getting investigated for fraud, I want out, and you drive the stock price down. So that's illegal. If you say, hey, I think this company is not going to do well in the future, that's perfectly legal. And you can have a big short position and say all these things as long as you are expressing an opinion and not lying about the company. And that's where that gray area is between market manipulation and free speech. So you can say, you know, I'm going to short GameStop because they're selling retail video games in a world that is increasingly focused on downloads and not buying of a physical game. Well, that's a pretty good analysis of GameStop's business. And you're not spreading any lies. You're not saying, hey, I'm going to short GameStop because their CEO just got caught hunting endangered species and he's going to get fired soon. When that's not true at all, unless you're Papa John's Pizza. But that's different.
And if like the GameStop analogy, and then if like the GameStop analogy, if you can go over the business model, but you don't have to talk about the new board members they got that have experience in e-commerce. That's why some people were starting to have faith in GameStop again, because it was looking to turn the business model around.
Yeah, you're allowed to say we're shorting, or you don't have to ever say why you're shorting it, but you can say, hey, we're shorting it because here's all the negative things, and never mention, hey, here's all these positive things over here. As long as you're not dealing in information that's not public. All information has to be public information. So you can't say that, hey, we're going to short GameStop because you know, their head accountant is my next door neighbor, and he told me that, man, they're about to get investigated for some kind of serious fraud. Well, that's not public knowledge yet. That's what insider trading is. That's highly illegal. But you can say, hey, I think GameStop's going to fail. We saw this. You saw a huge number of shorts go against PG&E, which is the power company in California, when they got blamed for the fires this past year in California. And they said, oh, yeah, PG&E, you were negligent and your power equipment started these fires that cost hundreds of billions of dollars in damage. Then everyone was like, yep, we're going to short PG&E because we think that they're going to just not be around anymore. That's perfectly legal.
So it's essentially a way to make a profit on a low market, or if the market is just not doing well.
Yeah, or on a company that's not doing well. Or it doesn't have to be a company that's doing terribly. It's just a company that you think the stock's going to go down. You know, stock prices fluctuate all over the place. The whole idea behind the short sale is you can make money when the stock price goes up, or you can make money when the stock price goes down. And it doesn't have to be.
There's that guy who was trying to short Tesla for like years, and he only gave up when the price of Tesla started skyrocketing like last year.
Yeah, I mean, you can short a stock because you just think it's overbought or too popular. Tesla has quite a few shorts on it because, you know, people think, hey, you know, we think the stock is going up, not because the company's doing well, but because it's the next newest, coolest thing, and that's why people are buying stock. Once they realize it's not as valuable as they think, the market's going to go down. In that case, people buy shorts and that kind of stuff all the time. Short sales happen a ton. I mean, this is a huge part of the market. It just kind of came to light recently because of what happened.
Would it be possible that some of these hedge fund companies together decided to short a particular stock, which manipulate the market in such a way that the price would fall?
It does, yeah. And that is legal because the amount of shorts out there is public knowledge. You can go and find, and I have the website, I can't remember what it is, but you can go and look up how many, yeah, I mean, and that's a market, a number that a lot of people use. You know, the big ones that are shorted now, Dillard's, Bed Bath & Beyond, Macy's, you know, all those kind of big retailers that are dying. There's a ton of shorts out on them. And you
I think that's why the whole situation started, was someone saw that short percentage on GameStop was so high, and like,
yeah,
don't think GameStop's going bankrupt in 2.
All right, our last term is a short squeeze. So you've got the short sale. We know the short sale happens. Then you got the short squeeze, and this is big on, and once we get these together, we'll see how these all interact. So on the short sale, at the end here, this is the key part. The person in the short sale has to buy all these shares back and return them. Which means if you have a really, really short position, let's say you're short 500,000 shares, so you borrowed 500,000 shares. Regardless of what happens to those shares, you have to buy them back when this contract is up. So the short squeeze occurs when you have an increase in demand because of short sales. Because you're requiring people to buy back stuff that they borrowed. So the idea is the short, we're referring to a short sale. Squeeze, basically where this is squeezing the price upwards. Squeezes the price upwards because demand increases. So that's a short squeeze. Now let's take a look at what happened specifically over these last few weeks. Let's get our triangle of doom here. All right, so over here, we've got two pretty big hedge funds. Melvin Capital and Citron Research. These are the two largest holders of shorts on GameStop. And we have GameStop. If you're familiar, they are a brick and mortar retailer. Brick and mortar meaning they have a physical presence. They're a brick and mortar retailer that buys and sells video games, consoles, things like that. So we know that over the last 10, 15 years, brick and mortar physical presences have been dying out. Retailers are dying. We see this all over the place, getting replaced by online, the online market. So the idea behind GameStop was people were looking at this and saying, yes, I mean, they're not doing terribly. I think their revenues were still in the low billions. They were doing pretty well. The problem is they were a physical retailer, and we know physical retail is dying. And the other one is their market, what they buy and sell. They buy and sell physical games, video games. So that market is also dying and being replaced by downloads. Not as quickly as retail's dying, but it's becoming replaced by downloads. So a lot of people looked at GameStop and said, all right, you got two things going against you. You're a physical presence retailer, which is very, very expensive, and the market that you deal with is kind of dying. So a lot of people said, yeah, GameStop, I don't know if it's going to go bankrupt. I mean, come on, JCPenney's hasn't gone bankrupt yet. And, they've been around forever. And I've never met a single person that went into a JCPenney's, and I think there's only 450 left. And they were at one time the largest retailer in the entire country. So they think that, it's not like they're going to go bankrupt next year, but we think over the next 10 years, they're going to start just fading out. They're going to lose. They're not going to do as well. So that's where the shorts come in. So you have these two hedge funds, Melvin Capital and Citron Research, and they said, yeah, you know what? We're going to put a lot of money into these shorts. We are really, 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 really certain that GameStop is not going to do well. So they shorted GameStop. here. Stock symbol is GME. So they decided they're going to short GameStop heavily. And here's another issue with hedge funds is a lot of hedge funds, if they find something that they're pretty certain about, they go all in. So it's either we're going to win big or we're going to lose big. And for a while, they were doing pretty well because GameStop stock, it wasn't gaining. It wasn't losing much, but it also wasn't gaining. It was slowly dropping. And all shorts were gaining value because the stock price was slowly dropping. Then a couple things changed. And I think one of you mentioned new member of their board of directors who was the guy who founded and blew up in a good way, not a bad way. What's the pet food company? Rover.
Chewy.
That's the dog walking. Chewy, thank you. Chewy.com. Did really well. And he got brought on in the board of directors, and they said, all right, so maybe this is the start of turnaround for GameStop. Maybe GameStop is now realizing we need to move to the online market. So that's a good thing. And when he got brought on, those shorts kind of reversed. The stock did pretty well. And they said, oh, well, this guy clearly knows what he's doing. You know, he grew Chewy from nothing into this massive, massive online company for pet supplies and did a really good job at it. So maybe GameStop's going to turn around. And then this is where the new things happened. We have our friends over at Wall Street Bets. Reddit.com, if you are not, or if you've never been there, I recommend it. It's a social media platform, but it's taken most of the negative aspects of social media and solved those problems. It's not perfect, but it's a lot better than a lot of other social media platforms out there. And the best thing is it's pretty anonymous. So it's not like Facebook or Twitter where you're like, oh, come on, Uncle Roy, I never realized you were a white supremacist. Now this comes out. So it's a good place. There's just a lot of good content on. There's a lot of bad content on there too, but a lot of good content. So anyway, that's my plug for Reddit. So Reddit, huge multimedia platform. And one of their, and I'm going into detail about this in case you're not familiar with Reddit. If you are, you will already know this. One of their pages, which they refer to as subreddits, is Wall Street Bets, which we call WSB. And Wall Street Bets was, it kind of started out a little bit as a joke for people getting involved in investing and just kind of doing crazy, dumb/smart things. It turned into a little bit better than that. It's very entertaining. Don't go there for all of your investment needs, but it's very entertaining all the same. So they started talking and they're saying, hey, like GameStop is heavily shorted, like really heavily shorted. Like there's more shares of stock that are shorted than are in existence. And they said, you know what that means? At some point, we're going to see a short squeeze. We're going to see all of these stocks have to get bought back. So they're sitting now, I think the last I saw was they had about 3.2 million people on Wall Street Bets. The number's probably bigger now because they went private.
It's 7 million now, or last I saw.
Okay. It was like 3.2 million last week.
I heard it's actually past 8 million.
All right, we're going to just say it's a lot. How's that? There's a lot of people on there. It's massive. And they went private. They took the page private, so now you have to subscribe in order to be on there. So there's a lot of people on there. So they started talking. They said, hey, if we buy up GameStop and then hold it and just not sell it, the price is going to skyrocket because Melvin Capital and Citron Research have to buy all these shares back. And if we can, and this goes back to basic economics day one, we know that demand is going to be high. Let's move this over a little bit here. So we know that demand is going to be high, really high. So if we can buy up all the shares of GameStop that we can and hold on to them, man, we're going to restrict supply, and that's going to make the price explode because Melvin Capital and Citron Research have to buy these shares back. And if we hold on to our shares, we restrict that supply, they're going to have to just start offering us more and more money. Because remember, you can't force somebody to sell their stock. You can only say, hey, I'm going to offer you this money. And this goes back to, again, day one, we talked about incentives. Hey, I want to buy your stock for $30 a share. I don't want to sell it. Well, nobody else wants to sell it either. How about $40 a share? I don't want to sell it. And the price keeps going up until they say, how about $340 per share? And then people say, okay, well, I've got a couple thousand shares that I'm now holding, so that's going to net me $6 million or whatever it is, or that's going to make me $400,000. So at some point, there's always a price for everything. Somebody's going to say yes. This is what happened. This is new because never before have retail traders, you and I trading stock were known as retail traders, have retail traders joined together and said, let's hold on to this. And it clearly worked because GameStop, I think it was 1,700% was how much the stock went up, which meant that if you owned it at the lowest and sold at the highest, you saw a 1,700%. That's a huge amount of money. You saw a big return. Now, what that means for Melvin Capital and Citron Research is they saw a hit of 1,700%. And they lost, between the two of them, billions of dollars. Last number I saw was 7 between just the two of them. And that's just 2 hedge funds. So they lost $7 billion, which was about 50% of their entire holdings. So that means if you had money invested with Melvin Capital or Citron Research, the money that you had invested there just lost 50% of its value. So if you put your $1 million into Melvin Capital, you now have $500,000 with Melvin Capital. Because, and let's go back over here. I didn't think we kind of covered this. This is what happens with the opposite. So if we're going to look at the short sale here, well, when the price goes down from $10 to $3, you earn $7 a share. What happens, now let's go green. We're going to do this in green. What happens instead of it from going $10 to $3? What if it goes from $10 a share to $350 a share? Well, that means
just lost $340.
You lost $340 per share because you sold them originally at $7 and now you've got to buy them at $350. So, you know, the old thing, you got to buy low and sell high. Well, you bought really high at $350 and then you sold it at $10. So it's no different than buying the stock at $350 and then selling it at $10. You see in the opposite direction. So that's what happened to Melvin Capital, Citron Research, as well as a couple other, or a few other firms. And again, the reason that is so big and why this is historical is because of what's happening over here. Because never before in history has somebody said, hey, let's look at this information that's public knowledge, shorts like this, and let's make a group effort to hold on to our stock or buy it up as much as possible and drive the price up. Because we know that there is a buyer out there that has to buy this stuff. So that's what happened the last couple weeks. And that's why this is so historical.
So
short sale or short. Yeah, sorry, go ahead.
What would now be a good time for hedge funds to short GameStop because it's not worth what, $300 a share, right? So it's eventually going to come back down.
It is, and they're still hovering at about 150% of shares being shorted. So there are still some heavy shorts. What happens is this can still repeat. You can short at 350. If you can keep the price high and the price continues to go up, you're going to have another short squeeze. So
yeah, the Redditors are going to keep holding because they keep getting pushed.
They keep I've been looking at Wall Street Bets, and like every time there's a dip, they're like, buy the dip to get more hold. And there's speculation because of the Robinhood fiasco last week. Part of why we're seeing it dip a little bit more this week is just because there's a lot of people in the process of switching their portfolios over from one broker app to another, and that we might see it spike up again at the end of the week once those processes settle.
I mean, people are saying that the Melvin and Citron have friends in high places, and they're going to be trying to block the Wall Street, the Reddit users anywhere they try to buy in.
Yeah, which is interesting because you can't really, because it's an open market, you can't really block anybody from buying. Now, the individual, like it was Thinkorswim or TD Ameritrade and Robinhood blocked purchases, which is, I don't like to voice my opinion very often, but I think that was definitely a very bad move because now you're seeing people dump Robinhood as quickly as they jumped into it. And coming over to E-Trade, because E-Trade, I just checked this morning, I could go buy as many as I wanted. I didn't, but I could go buy as many as I wanted. So yeah, it's interesting because the Securities Exchange Commission, and they're the ones who regulate all this kind of stuff, they've been kind of silent about this because, you know, for one, generally government regulation doesn't move quickly. It's not a fast process, nor should it be. But this is something brand new, and it's kind of like, you know, you're the Securities Exchange Commission. You're like, what are you going to do about this? And everyone's kind of like, we have no idea because we've never, ever seen this before, ever. You know, and it's interesting because you watch, if you get a chance to watch any of the, so on CNBC here, I'll jot this name down if you want to do it. So Jim Cramer, if you're familiar with him, doesn't always give the best. I mean, he gives pretty good advice, but not great advice. But he's kind of this crazy, he's an old hedge fund manager, and he does commentary now for CNBC. He's a very entertaining guy. He actually makes financial news very entertaining. He's got this big personality, and he speaks his mind and yells. Watch him speak about the regulation or you know, the threat of regulation from the SEC. He hates it. And it was funny because he managed a huge hedge fund. It was the third largest in the country for about 25 years. And he said the same thing. You know, he was like, we did this for 25 years. You know, if you go all in, that's the risk you take. You know, it was interesting. He's kind of like, all right, Melvin and Citron, you took a big risk and you lost money. So, oh, well, screw you. Yeah, he loves this stuff. He thinks it's great. So yeah, there's a lot of big investors who were kind of like, yeah, that's what happens when you throw all of your eggs in one basket or have all of your money into one investment. If that investment goes bad, you're going to lose a ton of money. That's why we tell individuals, don't take all your money and buy one stock, diversify. So hedge funds aren't always known for that, but yeah, it's interesting.
I'm also kind of wondering how much of it is you're this economic effect person who's worked on Wall Street for years, and now it feels like you're getting beaten by a bunch of people that literally call stocks stonks and keep calling themselves like degenerates and apes.
Well, it's interesting because I think Cramer's like 65 or 70 years old. And he is 100% behind Wall Street Bets. And he, you know, his whole thing was it's about time retail investors got together and made this kind of stuff happen. So yeah, he's an interesting guy. And he, like I said, he speaks his mind. He yells at people. He was actually at NAU once for the They have an annual economic conference. He's a phenomenal speaker, and he's hilarious, and he doesn't care. He just yells at people. But he's smart. He's brilliant. He knows the stuff. Like he's been doing this his whole career. And he's yelling at people about this stuff, but he also is making a really, really good point of like, yeah, you got beat by a bunch of degenerates, as they refer to themselves in Wall Street Bets. You got beat by a bunch of degenerates. Do better next time. Yeah, it's pretty fascinating. So we don't talk about it in this class, but in microeconomics, if you take that, hopefully you will, we talk about the housing market crisis. And I always tell people to watch the movie The Big Short. If you haven't read it, it's a phenomenal movie. And guess where that term came from? That is the same thing we're talking about right here, short sale. In this case, it was short sale on the housing market. So similar to what happened in 2009. 2009, it was a much, much larger, it was the entire housing market. It was a $1 trillion industry versus a low $1 billion industry like this, but same exact thing happened, same kind of concept. So check out The Big Short if you get a chance. Very entertaining, great movie, by the way. All right, great questions too. Any other questions on this or comments? Cool. And this isn't over. This will continue on. Like I said, this is a very new thing. I find it exciting just because it is new and we are living through history right now. And I am hoping, and this is purely opinion, this is not fact, I am hoping that we don't see a lot of regulation come out of this, because this is what the market is all about. Sometimes you win, sometimes you lose. And if you make bad decisions, sometimes you lose really, really big. So hopefully we don't see. What?
I think there were some against Robinhood and some of the other ones that blocked buying for some of these stocks.
Yeah, the lawsuits were coming from Robinhood customers when they couldn't buy shares of stock. I don't think those are going to go anywhere because as a brokerage, you can restrict whatever you want, whenever you want. That is free market right there. That's you saying, hey, it's kind of like, I don't want you to buy, a bartender saying, hey, I don't want you to drink anymore because I think you've drank too much. It's kind of what Robinhood was doing. Maybe not for the same good reasons, but doing it all the same. But the interesting thing is there's really, and the legal aspect of this, people are still trying to figure out. And there was a securities attorney on, they were interviewing this big securities lawyer on CNBC last night. And, they were saying, what legal action does Melvin Capital and Citron Research have? And, and this guy here is an expert in this, and he flat out said there's nothing. You can't sue retail investors for ganging up, using the information that's out there and making a decision. There's nothing illegal about it.
I think
trial files.
I think what made this different from what we've seen previously is that social media gave these individuals the platform that other investment firms have had previously. So they could put enough weight behind the stock to actually shift it.
Oh, yeah.
So they can manipulate it.
I mean, any other hedge fund could have gone in, looked at those numbers, and they could have bought up, taken their money and bought up GameStop and held it. All Wall Street Bets was doing, instead of having an organized organization or a fund doing this, it was just a whole bunch of people agreeing to do this thing.
I think another reason
which is, like I said, that's
is there's also kind of like,
yeah,
because when I was looking at Wall Street Bets, there's a lot of people that kind of have bitter memories of the housing crisis, and they're seeing this as a way to get one back at Wall Street for that.
Yeah, there's a sentiment that it's actually Occupy Wall Street too.
Except effective, because Occupy Wall Street wasn't that effective. This will actually be effective. I don't think this will change anything. I don't know if this is going to change anything, but it's interesting to, it's kind of like this is how the market works. We've just never seen it work like this before.
Do you think companies will crop up now that call themselves like anti-hedge funds that just pay attention to what the hedge funds are doing and then attack them in the same way?
They would.
Yeah.
That's just what a hedge fund does, though. You can call yourself.
Yeah, but it's a hedge
fund.
fund that's not, requiring millionaires to be in it. It'd just be like an anti-group, which is just poor people screwing over the rich groups. I
That
guess.
could be
But if
one
they were
that's,
doing those kind of investments, they would have to register as a hedge fund. So it's kind of this catch-22, where if you want to do that, you have to register as a hedge fund, which means you've got these limitations.
I see.
but,
I think there's going to be a whole nother group of people that's job is to watch like Reddit and Facebook groups now, right? Like they're not going to get fit in.
Yeah, so all of these, your entry level, if you want to get a career in finance, your entry level job generally out of graduate school, you would be an analyst. If you heard the term analyst before, that's just the term they give. So guaranteed now you've got these firms that have an analyst, an entry level person whose job is to go to all these sites and monitor what's happening and what people are talking about and report on that. And that's no different than, we want you to go and, you go into what analysts usually will do is they'll go on to quarterly calls. You have the CEO usually does this big Zoom call where anybody at all can watch, and they talk about what they're going to do the next 3 months or their yearly plan. That's usually what analysts do. Or they'll look at other information that's out there. It's just another piece of information for firms to deal with. And yeah, hopefully they have somebody on there, if they haven't already, to look at this stuff and monitor this stuff. Now, there is a way to overcome that. You talked about the anti-hedge fund. You don't have to start as a fund. You can actually start what's called either a mutual fund or an ETF, where you take that fund and you invest in stocks that are heavily shorted. And that you could do that and then have people invest in that. And that would be a way to overcome the hedge fund needing for that. But yeah, it'll be interesting.
Possible that's what Wall Street Bets will turn into once this comes down, because the coalition they've made, it's probably not going to stick together because there's no leadership. And that's what made it work.
Yeah, but you could put together a mutual fund that says, hey, we only buy stocks that are heavily discussed on Wall Street Bets. And then you do that and you can sell shares of that mutual fund or that ETF to individual investors. And that's no different than, we don't cover ETFs in this class or mutual funds. Basically, it's like buying a share of stock that's invested in a whole bunch of other shares of stock. So you can say things like, I want to invest in retail stocks, but I don't want to do all the research that tells me, what are all these retail stocks I should do. So you could have an ETF, and it's called an exchange traded fund, that basically says, we're going to buy all these stocks from all these retailers, and then we're going to put them into this big bunch, and then you can buy shares of this bunch. And then if the retailers go up, the value of the ETF goes up. If the retailers go down in value, the value of that ETF goes down. You can do the same thing, but instead of retailers, you can say, we're only going to buy stocks that are suggested by Wall Street Bets, and then have people invest in that. There's your next idea. That was an awesome class. That was fun. Any other questions or comments? Cool. Awesome job. Super happy we talked about this today. Hopefully this answers some questions. Yeah, we'll keep you posted on what's happening with this. And definitely, if it interests you, keep reading about it. Check out Jim Cramer. Watch him yell at people about what's going on here, because he's fascinating to listen to. And people listen to him when he yells because he knows what he's doing. Cool. Other than that, if you have any questions, I'm going to stay on.